Last week, Spirit Airlines defaulted on $1.1 billion in aircraft-backed bonds. That bond pile is bigger than Connecticut's annual pension contribution. The people eating the loss never bought a Spirit ticket. If you've got a pension or a money market fund, you just took the hit. Let's walk the dominoes. So the first big question is who actually pocketed the money when gas jumped from $3.17 to $4.44 in 6 weeks? The answer isn't the oil cartel, and it isn't Iran. It's 3 companies headquartered in Texas and Ohio. According to the U.S. Energy Information Administration, the Gulf Coast 3-2-1 crack spread, which is the dollar margin a refiner makes turning 1 barrel of crude into gasoline and diesel, more than doubled in the first 6 weeks of the war. It went from around $15 a barrel to a peak above $32. Marathon Petroleum, Valero, and Phillips 66 split most of it. Here's how the mechanism actually works. A refiner buys crude weeks before they sell the gasoline. They've got it sitting in inventory at the old price. When Iran escalates and crude jumps overnight, the refiner doesn't have to pay the new higher price for what's already in their tanks. But the gasoline they're shipping out the back gate gets repriced to the new market level immediately. So for the first 3 to 6 weeks of any oil shock, refiners sell at the new high while their cost basis is still at the old low. The traders call this the harvest. The economists call it crack spread expansion. I'm calling it the crack spread heist because that's what every modern oil shock turns into within 10 days of the news cycle. The number is $1.30. That's how much of the per-gallon pump increase went straight into U.S. refiner margins, and none of it went to crude producers or gas station markups. The big 3 refiners' combined operating margin came in at the highest level since the 2022 spike. The year-over-year change was roughly $8 billion in additional margin captured from a domestic consumer base that had no negotiating power to push back. Now here's the part that's actually wild. The United States has been a net exporter of refined gasoline and diesel since 2011. So when refiner margins explode at home, American refiners aren't actually capacity constrained, the constraint is on price. They could easily ship more product into the domestic market and bring prices down. They don't, because every additional gallon they ship lowers the spread for every gallon they were already going to sell. Sitting on capacity during a shock is rational profit maximization. It's also why a $30 per barrel increase in crude routinely lands as a 90 cents to $1.30 per gallon hike at the pump within 10 days, even though the math should put it closer to 70 cents. By now you're probably thinking, wait, that can't be legal. It is, and it's working exactly as designed. The crack spread is a publicly disclosed, daily quoted financial spread. Every refiner reports it on their quarterly call. Wall Street analysts upgrade the stocks the moment the spread widens. The system isn't hiding the heist. The system is the heist, and it actually gets worse from there. The cash that the refiners just harvested isn't going into building more refining capacity, which is the only structural fix that would prevent the next spike from doing the same thing. It's going into stock buybacks and special dividends. Marathon authorized a fresh $5 billion buyback in late April, and Valero added another $2.5 billion of their own. The cash is leaving the productive economy entirely and landing in the brokerage accounts of whoever already owned the equity. So the windfall isn't even being reinvested in capacity that could blunt the next shock. It's being converted into reduced share count. My local Costco station went from $3.07 to $4.21 in 11 days. That extra $1.14 a gallon on a 14-gallon tank is $16 per fill-up, which is fine, until you realize the only company better off, because of all this, is the one that owns the refinery 500 miles away. The Iran shock didn't make America poorer in aggregate. It made U.S. consumers about $80 billion poorer over 6 weeks. It made U.S. refiners about $8 billion richer over the same window. The other $72 billion went into the same place every energy shock sends discretionary income, which is nowhere. But the refiner profit doesn't explain why Spirit Airlines, of all the airlines, was the one that folded. United, American, Delta, and Southwest are all paying the same higher jet fuel price. The legacy carriers and the budget carriers are all eating the same energy cost on the same routes. So why is there only one stack of 17,000 pink slips, and why did all of them belong to the company whose business model was supposed to be the most resilient to fuel cost increases? The hedge Spirit couldn't afford is the answer. Every major U.S. airline buys insurance against jet fuel price spikes, and that insurance has a name, and it's called fuel hedging. The way it works is the airline buys options or futures contracts on heating oil, which is the closest publicly traded proxy for jet fuel. If oil spikes, the contracts pay out and offset the spike. If oil drops, the contracts expire worthless and the airline pays the premium for nothing. The premium isn't even trivial. Hedging your jet fuel cost runs you somewhere between 4 cents and 12 cents per gallon over a multi-year program, depending on how much you're trying to lock in. Here's the number that explains it: roughly $1.4 billion. That's what Delta Airlines spent on fuel hedging premiums between 2020 and 2025. They hedge about half their fuel exposure on a rolling basis. When the Iran shock hit, Delta's per-gallon jet fuel cost rose, but only by about half as much as the spot market move because their hedge book was paying out exactly as designed. United and American run smaller programs but still have meaningful coverage. Southwest is the legendary hedger. The carrier's entire low-fare model in the 2000s was built on locking in fuel prices when nobody else would. Even after they trimmed the program in the 2010s, they kept a partial book that paid out hard during the spike. Now here's where the gap shows up. Spirit Airlines stopped hedging fuel in 2022. They quietly eliminated their hedge desk during their first restructuring. The reason wasn't strategy, it was straight-up cash flow. Hedge contracts require collateral, and during 2022 Spirit was already over-leveraged from the Frontier merger that the Department of Justice had blocked, and from the JetBlue acquisition that the federal court had unwound. Spirit had to choose between paying hedge premiums and paying leaseholders on the planes themselves, and they chose the planes. 3 years later, when the Iran spike hit, every other carrier was buffered by their hedge book, and Spirit had nothing to fall back on. And here's the part almost nobody outside of two trading desks understands. The same shock that killed Spirit was a windfall for Delta. Delta's hedges paid out around $400 million in the 8 weeks following the Iran escalation. That cash didn't come from nowhere. It came out of the same crude futures market the refiners were also trading. The hedge counterparty is usually an investment bank or a commodities trading house. The bank passes the loss back into its book, eventually rebalancing through the spot market. So the airline that hedged got paid. The airline that didn't hedge got vaporized. The two airlines weren't in the same business at the moment of the shock, even though they appeared to be. Spirit's fixed costs were also worse. They were running an aging A320 fleet that gets about 4.6 cents per available seat mile in fuel cost, where Delta's newer A321 Neos burn closer to 3.7. So even before the shock, Spirit was paying about 24% more per seat mile in fuel than Delta. When Brent crude went from $80 to $112, that 24% premium suddenly became fatal. Every flight Spirit was running on a contested route, which by 2026 was every route Frontier or JetBlue was also running, became a guaranteed loss. The carrier didn't slowly bleed out. The carrier ran out of margin overnight. And here's the control case for that. Frontier Airlines runs the same ultra-low-cost carrier model as Spirit. Same type of plane, same type of route network, same type of margin profile. Frontier kept a partial hedge book through 2025. When the Iran shock hit, Frontier's fuel cost rose, but the hedge payments offset enough of the spike to keep margins from going negative on contested routes. Frontier reported their worst quarter in 3 years, but they didn't fold. The difference between Frontier surviving and Spirit not surviving was about $200 million in hedge premiums Spirit had cut 3 years earlier to keep cash on the balance sheet. The other piece nobody mentions is the Wall Street pressure that put Spirit in this position in the first place. Analysts spent the entire 2014 through 2020 stretch of cheap oil pressuring airlines to drop their hedge programs. Hedging was framed as an unproductive use of capital. Carriers that hedged got penalized in earnings calls for their hedge losses during the cheap oil years. Spirit did what the analysts wanted and cut the program entirely. The same analysts who praised that decision in 2021 are now publishing notes calling Spirit's collapse a failure of risk management. The risk management decision was made for them by the people now writing the postmortems. And the 17,000 jobs that came with the wind down, those are the visible damage. Pilots, flight attendants, gate agents, mechanics, ground crew, headquarters staff. The airline industry generally absorbs that scale of headcount during shocks because hiring at the legacy carriers is tight. United and American have already started reaching out to former Spirit pilots and mechanics, so the labor side of this collapse will mostly recycle within a year. The labor side isn't the part that doesn't recover. Because the hedge book is only one half of why Spirit went down and Delta didn't. The other half is who actually owned the airline, and what was on the hook wasn't the equity, it was the debt. Spirit had been borrowing against its own physical assets for years, which means when the carrier defaulted, the people on the hook weren't the executives and weren't the shareholders. They were the people who'd bought the bonds. And almost none of those people knew they were on the hook for a discount airline. Welcome to the aircraft bond pipeline. That's what almost nobody outside of 3 trading desks understands. When an airline borrows money to buy a plane, the plane itself is the collateral. The bond is structured through something called an Enhanced Equipment Trust Certificate, or E.E.T.C for short. If the airline defaults, the trust takes possession of the plane and auctions it off, and the proceeds go back to the bondholders. In normal times, that structure makes the bonds look almost as safe as Treasury securities, because there's a hard, physical asset standing behind every dollar. The airline industry has been issuing this type of paper since the 1990s, and the total outstanding market is somewhere around $50 billion right now. Spirit had about $1.1 billion of these notes outstanding, paying 8.00%. They were collateralized by 36 of the airline's owned A320s. When the carrier defaulted, the trust seized those planes, and so far, so structurally normal. Here's the part that breaks. The secondary market for used narrow-body aircraft was already glutted in 2026. JetBlue had wound down their A320 fleet 2 years earlier. Air India had returned about 80 of theirs in a separate restructuring. Frontier had overordered new planes during the post-pandemic boom. So when Spirit's 36 planes came onto the auction market, the recovery price wasn't the textbook 70 to 80 cents on the dollar. It was closer to 30. That means the bondholders who thought they had a senior secured position with hard collateral behind it ended up writing down about $750 million in losses on a $1.1 billion exposure. By now you're probably thinking, sure. But that's the bondholders' problem, and it isn't. The people who owned those bonds weren't hedge funds. They were pension funds, money market funds, insurance companies, and Treasury substitute exchange-traded funds. The yield was 8.00%. In a world where 10-year treasuries were paying about 4.4, an aircraft-secured corporate bond looked like a free 360 basis points of credit spread for what was supposed to be near treasury risk. Pension fund managers chasing yield are the largest single buyer class for E.E.T.C paper. The California Public Employees Retirement System, the New York State Common Retirement Fund, the Texas Teachers Retirement System, Vanguard's Prime Money Market Fund, and a dozen others all own slices of this paper. So the 17,000 jobs are the visible damage. The actual money that just disappeared is sitting in your retirement account, in a fund you can't directly see in a bond CUSI. P. Nobody at your company has ever read. And the write-down won't show up in your statement until the next quarterly mark, which is when the pension trustees will quietly add it to a bigger pile of losses they're already trying to amortize through return assumptions. And here's the part that won't show up anywhere you can see. Money market funds mark to amortized cost, which means a write-down of this paper inside a money market fund only shows up if the fund decides to mark it down voluntarily. They generally don't. Pension funds disclose holdings quarterly, on a lag, in PDF documents nobody reads. Treasury substitute exchange-traded funds reprice daily, but the price drop gets buried inside a basket of 2,000 other holdings. The aggregate loss is real, and it's substantial, and almost nobody outside of a fixed income desk and a few pension trustees will ever see it itemized. The reason this pipeline exists isn't that everyone got fooled. It's that yields were too low for too long. Pension funds that need to hit 7.5% return assumptions can't do it with treasuries paying 4. So they reach for credit spread. The aircraft-secured paper looked like the smartest reach in the entire fixed income market because there was a literal plane behind every dollar. The math only worked because everyone assumed the secondary market for used aircraft would always clear at 70 to 80 cents. That assumption was holding for 30 years. It stopped holding the moment 3 carriers all unwound at once. And then there's the contagion. Every other airline's E.E.T.C paper just got repriced. American Airlines notes traded down 11 points, United's traded down 7, and even Delta's notes traded down 4 despite the carrier's hedged fuel and strong cash. The reason isn't that Delta is in trouble. It's that the secondary aircraft market the bonds depend on for recovery has been revealed to clear at 30 cents, not 70. So the implied loss given default just changed for every E.E.T.C issued in the last decade. That's somewhere between $5 and $7 billion of paper losses sitting in U.S. pension fund holdings on top of the $750 million in actual realized Spirit losses. That's the chain that just played out. Iran escalates and Brent crude spikes overnight. 3 U.S. refiners harvest the first 30 days of the spread while every airline pays a higher jet fuel price. The hedged ones survive and Spirit doesn't. Spirit's secured bonds default into a glutted aircraft auction market, which prices the recovery at 30 cents, and every other airline's E.E.T.C paper gets repriced down with it. Pension funds and money market funds eat the write-down. Aircraft are one collateral class. The same pension funds own the auto loan-backed paper, the commercial mortgage paper, the private credit fund slices, and the corporate bond ladders. Every one of those receivable pipelines runs the same margin math that just left a billion-dollar hole in someone's retirement account. And the next one to break is already in motion.